Awesome. Thank you, Shayna. I'm just going to share my screen really quickly. All right, can everybody see that? Awesome. Hi, everyone. As Shayna mentioned, my name is Kinjal. I'm a senior associate at Blockchain Capital. I'm focused there on specifically investing in the blockchain industry as well as in crypto assets. I've been there for about 2 years, and prior to that, I was in Boston where I worked at Fidelity Investments. I was part of the consulting and strategy group there, and I was lucky enough to work with the team on both blockchain initiatives as well as some asset management projects. And as Manasi mentioned, I was also a little bit, getting involved with the blockchain community there, and I'm very much a fan of all of the women in blockchain initiatives all over. And so I'm really excited to be here. Thank you for having me. And so today I'm going to talk a little bit about the process of basically crafting your pitch. A lot of my experience over the past 2 years has been focused on more of a technical sector. So a lot of the pitches that I see are technical. So I'll spend a little bit of time talking about that. And I'm also focused more on early stage investing. So some of the sort of advice and tips that I have might be a little bit more geared towards early stage investing, but I think are broadly applicable. So without further ado, today I'm just going to cover a couple of different things. So first, I'll talk a little bit about how you approach investing, how you approach fundraising in general. So there's a couple of different approaches out there, and then I'll get into the pitch more specifically, some tips on how to sort of land a technical pitch, and then also just broader advice around the pitch deck as well and some of the materials associated with it. There's a plethora of advice and information on pitch decks out there, so it can be a little bit challenging to sort of navigate some of the advice that's out there. There's just a whole lot. So I hope this helps clarify some things. It's certainly representative of my perspective and my experiences. And so it's definitely more art than science, but hopefully I can kind of cut through some of the excess information. So to start, sprint versus marathon. So this is kind of something that I've coined in my head, or maybe I picked this up along the way, but there are two approaches to fundraising with venture capitalists. The first is the sprint method, and the second is marathon. And on the sprint side, some folks, this is where some folks suggest you fundraise in a really short period of time and you treat it like a sprint. So you kind of aim to have your fundraising done within a, say, 2 to 4 week cycle, or whatever seems appropriate given how much capital you're trying to raise and where you're trying to raise it from. And you do this over a shorter period of time to create some sense of urgency behind your round, right? When you're talking to a bunch of people at the same time, it can help create this sense of FOMO. And it's something that investors fall in love with, a lot more. FOMO is everyone's subject to that sort of sensation. So that's one approach. And then the second approach is taking more of a marathon approach. And this is basically where you build a relationship or a couple of different relationships with investors over time, and sort of cultivate this by providing them updates, whether that's on your product launch or what you're sort of building. And then over time, sort of bringing them along with you in the process before starting to raise capital. Some folks say that this leads to stronger relationships with their investors. However, this can also, of course, take a lot longer time. So I think there's benefits and trade-offs to both approaches. And it really is, not a one size fits all kind of a solution, but I bring up both because I think they're really important to how you think about fundraising. So if you're considering raising a seed round for a project that you're doing, I think it's really important to identify which approach you're going to start with or try. That way you can sort of find the right investors, identify your goals and the process that you want to take, and then prepare accordingly. And of course, preparation, everyone is going to prepare, but I think it differs depending on which approach you will take. So I'll just go one by one really quickly just to sort of demonstrate what I mean by this. So if you were to take the sprint approach, preparation is going to include, researching investors, lining up potential warm introductions, or perhaps if you want to cold email them, you can, line up some of the emails that you want to send out there, and really try to stack your meetings so that they're, going to all fall into a exact window of, say, 2 weeks or something like that. And when you're doing this, there's less room for error when it comes to your deck, when it comes to your pitch. Everything kind of needs to be polished and ready to go right before you start. Whereas a marathon, it takes a little bit more of a workshopping approach. You're talking to investors, you're sharing your ideas with them. You might be iterating in some ways, iterating your pitch as you go. And this process can drag on a little bit. And so of course your time is valuable. So just be cognizant of how much of a marathon it actually is. But there's definitely sort of these two, I think, large school of thoughts of how you can go about doing it. And when you're trying to find the right investors, I would really do some research and homework around, what types of investors are you looking for? Do you want angel investors? Do you want them to be a little bit more strategic, folks who can help you out with recruiting or marketing or PR? What's kind of like the crux of what you're looking for in terms of value add, particularly because these investors are going to be on your cap table and you want to make sure that you are optimizing for your goals and what your needs are. So this is just kind of high level, I think, how I think about the fundraising process if I were in a founder's shoes, and sort of identifying all these things beforehand is super important. So this is a little bit of the before, and then I'm going to now move into the during the actual pitch itself and some things that I've learned and seen over the past couple of years. So storytelling is really an art. And I've seen this come true in a lot of different ways over the past couple of years. So I've probably sat in on now a couple, maybe 100 pitches, maybe more than that over the past 2 years. And you start to see some patterns and trends of what's working and what might not be working as well. And at the end of the day, when you walk into a pitch, there's a couple of things that I think investors are really looking for. So first is to make it personal. I think this is something that folks sometimes think that, investors are really looking for the data and they really want to see, a lot about the market trends and a little bit more of like a business case for what you're building rather than a personal story. And I think the personal story is really what resonates in the room. So when I say personal story, I mean, how did you kind of come to where you are today? Why are you building this particular product or company, and how does it fit into your background and what problems that you're passionate about? So I would really say don't sacrifice the emotion for data. I think both are important, but just be cognizant of the fact that if you can kind of make it more personal and connect with the investors on some level and relate it back to your background, it's going to resonate a lot more. Or it's going to resonate, in a more meaningful way, I think, than simply presenting a bunch of data and trends, which is important as well, but potentially not the same impact. And then the third thing, exude energy. I know it sounds like an obvious statement, but I can't stress how much body language and eye contact and being really excited about what you're building can change the mood in the room. You can kind of tell within the first 5 minutes that a founder is really excited about what they're doing. And I can totally understand that it's exhausting, right? You might walk into a pitch and it could be your 15th or 20th pitch that you've given that week. And it's really hard to seem super excited about the pitch that you're giving. And I have so much respect for everyone doing this, but I think the energy aspect really can change the room's sort of overall mood and feel. So I highly recommend bringing that attitude to every pitch that you can. And then also just allocating your time. And this is something that I think people often struggle with, where they really want to include all the information that they can in a pitch meeting, right? This is your 30 minutes in front of an investor. Like, let's try to get it all in. Before you go into the room, I would urge you to sort of write down, say, 3 to 5 things where if you can only say 3 to 5 things to the investor, what would that be? And make sure that you hit those points. Specifically, I think folks tend to over index on things like their background and their bio. I've had 30-minute pitches where a founder might spend 10 minutes talking about their background and how they got to what it is that they're doing. And while that can be super interesting and useful in terms of contextualizing what you're doing, it can of course be a little bit challenging just from a time perspective, right? If you only have 30 minutes to cover everything. And then the last thing that I would say that I think people sometimes unknowingly do is you're going to iterate on your pitch. It's not going to be perfect the first time. At least for most people, it won't be perfect. So if you have the opportunity to time, maybe your top investors that you want to land meetings with, time those so that they're a little bit later in your process. Don't make your first pitches your dream investors. Leave a little bit of room for error. And I know that's not always possible, but when it is, that, I think can be beneficial so that you've had time to kind of smooth out any kinks that you might have before that. So when you're actually in the room with the investor, or in the Zoom rather, with the investor, what are some of the thoughts that are going through the investor's mind? So there's a few questions, and I know everybody kind of talks about these big questions, but I'm just going to go through each one and break down what I think we're thinking about when I'm in a pitch. So, what problem are you solving? This is, of course, the most obvious sort of starting point of, I'm building something, I'm building X, and the reason I'm building it is to solve this problem. The word of caution I would just suggest here is to ensure that it's clear that you're solving a specific problem and not all the problems. So to bring this to life a little bit more, if you're building something related to, say, the financial stack, many teams come in and they say, we've envisioned an entirely new financial stack top to bottom, and it's going to revolutionize the way that infrastructure works and payments work and all these sorts of things. And I think that vision is great, but from sort of a day one perspective, it's really important to have a honed in problem that you're solving and why you are the right person to go out and solve this specific thing. So I would try to narrow in on a problem. Of course, how big is the market? So everybody talks about market size being really important and demonstrating that the market is not only big, but growing. VC, at the end of the day, these are investors who are looking to make a return on their investments. And so they really need to believe that these are markets where you can kind of grow $1 billion business. What I found to be really useful is, instead of simply talking about how big the market is and some of the growth trends, I would also include dynamics in the market that you think are uniquely advantageous to what you are building. So perhaps an example for this would be, I talked to a lot of folks who are building in the blockchain gaming sector. A lot of them, point out the size of the gaming market, how people are moving to online gaming and are constantly buying these digital skins and buying digital assets. I think all of that is really helpful in terms of contextualizing that this is a really interesting opportunity, but perhaps some of the dynamics at play might be more useful to an investor to understand why digital assets could be a good use case here. So understanding secondary transactions to the extent that you can, or understanding consumer behavior in terms of how many people are buying Fortnite, skins, or whatever dynamic it is, deplatforming of gaming influencers, something that can kind of help you better understand what the dynamics are within this market that help you, that are advantageous to you. And then third, so why are you the right person to build this? I think this is a tough question, but I think to the extent that you can sort of exemplify why this problem is something either you are uniquely positioned to solve, or something that you've been really passionate about for a long period of time, and that you've demonstrated interest for, I think that goes a long way, particularly with early stage investing. Oftentimes, we're investing in a company that is pre-product or pre-revenue, and so being able to have that conviction and excitement about this being the right team is important. And I know that sounds a little squishy, but I think it really comes across between passion and demonstrated interest, as well as background and skill set that you bring to the table. So fourth, how have you validated this idea? I think from an investor perspective, it's great to show rather than tell. And I'll say this a couple of times throughout the presentation, but to the extent that you can show that, this is a real problem, that users are asking for this, that's going to help bring the investor along in terms of, not only is this a problem, but it's a problem that people are asking for a solution. And then lastly, why should I invest? So if I'm coming into the room, I think your goal is to, at the end of 30 minutes or 45 minutes, the goal is to really have the investor saying, oh yeah, this is a really interesting investment opportunity and I want to know more. I need to go dig into X thing, or from a opportunity perspective, this could be really big, solving a really big problem or filling a really big hole in the market. I would just kind of put on that lens of, it's less, why should I go build this, but more, why should I invest? And often the two are the same, but I think it just requires a slightly different lens when you're talking to an investor and if you were sitting in their seat and what they're thinking about. So I hope this is helpful. This is what I would kind of want to come away from if at the end of the pitch I was talking to a founder. I would love to have the answers to these questions and then be able to then go do some more diligence and ask some more questions. But this is kind of at a minimum what I really want to walk away from the conversation knowing. So getting technical. So as Shana mentioned, I have a degree in quantitative economics. So I'm definitely a little bit more math oriented, but I'm not a programmer and I don't have, a ton of computer science knowledge. But that being said, I do sit in technical pitches, 99% of time, given the focus on the blockchain industry. And so there's a couple of things that I think work really well for technical pitches, things that I think folks sometimes underestimate the power of. So first, explain it like I'm 5. This is self-explanatory to a certain extent, but some of the best pitches that I've seen have really started out first and foremost with a high level, like a 50,000 foot view of what is the most important thing that you need to understand about the technology, what problem it's solving, and how it works at a really, really high level. And I think people sometimes fall into the trap of using jargon or using language that might, the investor might not be familiar with, even if they are technical, simply because they might not know the specifics of what you're building. And that's when you start to lose folks in the room, when you're using too much vocabulary that is a little, is a little bit opaque, or they just might not know exactly what you're talking about. And I think the best way to demonstrate that you really understand the space that you're building in is if you can explain it like I'm 5. To me, when you keep it simple, that shows that you really understand the mechanics of how it works, and then peel back the onion. So then kind of go into more specifics on the technology and how, how some of the incentives of the protocol work, or whatever it is that you're talking about. I think you can go into a layer deeper as the conversation progresses. And I think what I would suggest as a potential exercise is you can practice this by saying, okay, let me try to explain what I'm building from a technological perspective in 3 minutes, in 10 minutes, and then in 20 minutes, and kind of have these almost like practice pitches of the tech in 3, 10, and 20. And that way, that you can still sort of communicate the most important information given the amount of time that you have and the amount of detail and depth that you want to go into. But that way you're not always just diving straight into the weeds, which I think is one of the toughest parts of a technical pitch. And then in terms of contextualizing the tech, so I think this is something that I've seen founders do extremely well, and I've also seen founders struggle with a little bit more, where when I say contextualize the tech, I really mean, use examples if you can, use use cases, talk about maybe the competitive landscape and how your technology is a little bit differentiated from some of the competitors. Use analogies if you can. Basically try to bring the investor along with how they might think about your technology in the broader landscape, both from what else is out there, but also from how you can use the technology. So For example, one of our portfolio companies is a company called UMA. I think the founder might have actually been on one of the Women in Blockchain talks previously, Allison, she's awesome. And so when they first kind of came in and pitched us, I was reading the white paper and I was talking to them, and they're basically building derivatives on chain. They're building derivatives that are built on a protocol called Ethereum. And from a technical perspective, there was a lot to understand, both about financial derivatives, but also how this would work in the context of a blockchain. And what they did throughout their white paper was they included examples of how you might be able to use these derivative contracts in, say, the developing world, or how you might be able to use it to create an insurance product. They had like 5 or 6 of these use cases. And I loved that from an experience perspective of someone who's not extremely technical, going through all the details, but then bringing it back to a higher level and saying, here's how this might be applicable, was really helpful. And I would urge, anyone who's building something really technical to kind of take this approach. And I think it'll resonate really well. And then lastly, visuals help. If you can put together some sort of diagram to explain what you're walking through. I'm a visual learner. I know lots of people are visual learners, and it can kind of be helpful to focus your eyes on something as you're, understanding and hearing about the technology. So if possible, I would definitely urge you to include a visual. So I kind of walked through a little bit of, before the pitch, and then actually getting into the room, some of the things that you might want to cover, and then technical tips just in terms of how to put together more of a technical pitch. And now I just want to walk through a couple of examples and things that I've heard from, or things that I've seen rather, from reviewing decks. So this is more about how to build a pitch deck itself. So this is a graphic. It's a little bit outdated now. It's probably a few years old, but this was put out by DocSend. And so DocSend is like a pretty popular presentation viewing software, actually quite controversial. I think there's a lot of people who hate it or love it, but essentially a lot of founders will use DocSend to send out their pitch decks. And when you look at a pitch deck, it actually tracks how long you spend looking at the slides. And it also kind of keeps track of how long, folks are, how long their materials are, and then how long it might take for them to actually close a deal. And there's a few other stats that are out there from different sources, but I thought this was just kind of a helpful way to anchor what the fundraising process might look like. So, on the left, this talks about 58 investors being contacted, 40 meetings, and it took about 12 and a half weeks to close 1.3 million in capital on average. So I think just from a shots on goal perspective, I think it's helpful to know that, walking into it, you might need to talk to, say, 40 investors or 30 investors or whatever that, magic number is. I think just preparing to be able to talk to as many folks as you need to talk to, which I know it can be a grind, but just sort of level setting some expectations in terms of what the process typically looks like. But then when we're thinking about the deck, it says 19 pages on average. I think that's pretty much in line with what I've seen, but it says 3 minutes and 44 seconds is the visit time. And I thought this stat was actually really surprising. I thought it was a lot lower than what I was expecting. And I'm sure there's a few discrepancies, but I think the point is investors are probably going to look at your deck for less than 5 minutes initially, and in less than 5 minutes they kind of need to walk away saying, okay, I want to learn more about this company. And I think that's fair. I think if you're looking at a couple, say 20, 30, 40 decks a week, you're probably not going to spend more than 5 or 10 minutes to kind of get an initial impression before you dig a little bit deeper. And so the way that I think about pitch decks is you sort of optimize for the minimum amount of time needed to understand all the content, but then be able to allow a viewer to then dive a little bit deeper into the details if they want to. So here's kind of an outline of what the deck could look like. I think this is very sort of standard in terms of things that you should include in a deck overall. And there's a lot of resources online that can kind of help you with structuring and what order things should go in. But at the end of the day, I think you need to talk about your problem, your product and solution, business model, your team, market, why now, or why you're the right person to kind of go after this, and then competition and financials. And I would kind of bucket the technology portion under product and solutions to spend a little bit of time talking about what tech you've specifically built in the context of, say, if it's blockchain or something else. And I think this sort of framework works fairly well. I've seen, some of the most compelling decks kind of cover these things, and even not much more than this. And I think they're still able to kind of get across everything that they need to communicate with an investor. And so I think the 3 principles that I really look for are, first, keeping it simple. So that's the sort of KISS methodology. I think it might stand for keep it simple, stupid. I'm not sure. I think that might be what the last S is. But basically, I think when you can simplify your slides, please do. It would be, I think sometimes folks think of pitch decks as decks that are a little bit more reading decks, and they're somewhere in between a presentation and a reading deck. I think there should be words on the page, and you should, of course, walk the investor through, whoever is viewing the deck. They should be able to sort of come away with an understanding of what the problem is and what the product is. But at the same time, if there's too many words on the page or too much complexity, you're going to lose them. So I would really try to narrow it down to, like, what is the 1 point I want to make per slide? Maybe 2 points max, but like 1 to 2 points per slide that I really want to communicate. And that way you are able to hone in on the points and then ensure that it also stands alone. So a trick that we used to do when I was back in my consulting days at Fidelity is we would just remove all the slide content and just read the headlines, and make sure that the headlines, if you only had that information, you could still kind of piece together what you're doing. I think that could also stand here, or, if not the headlines, then like the 1 bullet point or 2 bullet points that you would want to make sure are on the slide, kind of leave that and put that all on the page and see, can I still sort of understand what the company is doing, what they're building. And then showing and rather than telling, I think this applies whether it's, your ability to show customer feedback, traction, a demo of what you've built, anywhere where you can show rather than telling is going to be a lot stronger and helpful when you're looking at a company. And then just a few do's and don'ts of things that I've seen work and potentially not. So definitely use numbers, past and future. So if you have any numbers for traction, and if you have any financial projections or future projections of how growth might look like, I would urge you to try to include these. Sometimes if you're really early stage, it can be tough because you might not have anything launched yet. And that's okay. But I think to the extent that you can include data, I would really try to, and data as it relates to what you're building. I think that's just always helpful. Use the appendix to your advantage. So as I mentioned, the main deck should be short and concise, but if you want to use the appendix to address all and any questions that you think might come up, that's a perfect place to do that. In fact, if I'm looking at a deck, I might spend 5 or 10 minutes on the actual, upfront deck, but then later on, when I'm preparing for our meeting or when I'm doing follow-ups afterwards, I'll spend a lot more time in the appendix, particularly if there's details around, let's say, the technical architecture and the technical details of what you're building, or financial projections, use of funds, any sort of extra material that you think would be helpful for an investor to kind of know, I would stick it in the appendix. And then I think customization is helpful. One of the biggest ways I've seen folks customize when they're raising for a blockchain-focused company is sometimes you'll be talking to the blockchain capitals of the world. Sometimes you'll be talking to, say, a more of a generalist fund, so a Sequoia or a Benchmark or something. And I think there's a varying level in terms of in-depth knowledge of blockchain technology. Not to say that someone at Sequoia doesn't know the market well, but they might just not know it quite as well if they don't spend all their time doing that. So I've seen folks customize their decks according to that sort of audience. Also, I think like right now is a perfect time. COVID, I think a lot of people have included a COVID slide in their decks or some sort of reference to the times that we're in right now and how that may or may not have altered their plan. So just, where you think it's applicable, try to customize both to audience as well as to the circumstances. And I think it's not going to be always like a one deck fits every situation. And then on the don'ts, don't try to address everything. I think I've probably said this a couple of times now, but yeah, just really try to hone in on, what are the most important things that you need to know, and make sure you don't bury that punchline. And then the last thing is, don't use too much jargon. I think this is so important, both in blockchain pitches, any sort of technical pitch, if you're doing something in AI, whatever it may be, the use of jargon, even if I understand the jargon, is going to drive the investor away. I cannot tell you how many times I've seen a pitch where there's so much jargon that I find it really hard to kind of decipher what exactly you're saying. And that's an automatic, a little bit of a turn off, right? Because you're making me work really hard to understand what exactly it is that you want to do. And it can be a little bit of a distraction. So yeah, those are kind of my high level do's and don'ts. I think at the end of the day, if you are, really clear about what you're building, why you're building it, why you think it's going to be a really interesting opportunity, that will come across. And it's really just a matter of how you organize the information to make sure that that's really clear. So I've included a couple of resources here. There are dozens of resources online. At the end of the day, like I mentioned, hopefully you can, this is a little bit helpful in terms of getting some clarity on how I view things and how I think things have worked with founders that I've met with. But there's a lot of resources online, so I urge you to, go check them out. And then if anyone is, raising capital or thinking about raising capital, or just wants to chat about their pitch deck, I'm happy to look at pitch decks, anything, just always happy to answer questions, and you can find me here. So here's my my email and my Twitter handle. And with that, I think that kind of concludes the formal presentation. Thank you again for having me. I really appreciate you guys taking the time to come out, and then I appreciate Women in Blockchain and Women Who Code organizing this for me. So thank you very much, and I'll take any questions.
Thank you so much, Kinjal. This is great. So I guess I can kind of just read them off to you. Does that work for you?
Yeah, that works.
Awesome. So we have a question here from Kat. I would love some more clarification on how market dynamics are different than market trends.
Yeah, so that's a great question. So I guess I would point it two ways. So when I think of market trends, I'm going to go with the gaming example, just because I know that's what I talked about earlier, and I think that might help clarify. So I would say, at the very base, someone might say the gaming market is $180 billion and it's growing at 11%. And then some of the market trends might be users are flocking to mobile games, and mobile games has really beat out everything else, or free to play games is the way to go. Those are great trends to kind of point out. Some of the dynamics, I think, is a little bit more nuances around, say, user behavior, or say like the technology that's prevailing in that particular market, or potentially any anecdotes that they might have about the use case for what they're building. So it's not so much that it's different, like it's, you could call it trends as well, but I think of it a little bit more as nuanced information about the market that will be helpful for the specific thing that you're building. That makes sense. Hopefully that's helpful.
Great. Kat says thank you. Grace asked a question. You mentioned you do due diligence after the pitch. Can you say more about what that process is like? What are the things you're checking or doing further research on?
Yeah, sure. So, I think everyone's diligence process is going to differ a little bit, but from a high level, the way that it works for me and for what we do at Blockchain Capital is I'll sort of take our conversation that I've had with the founder and, digest a lot of that information, and then kind of fill in the holes for myself. So a lot of times I might know, the area that you're building in and have some familiarity with it, but I might not know all the intricacies. So I might want to read up a little bit more on the sector more broadly, better understand who some of the players are, reread some of your materials to make sure I understand everything, and then come back to you with follow-up questions. So it's really about, there's only so much that I know before going into the conversation. And after I come out, I'm probably going to have a little bit more follow-ups that I want to do and digging in. And that might even include things like, market sizing or, market research. So yeah, it kind of covers a wide spectrum, but that's the general gist. And then, as you get further along in diligence, it'll include things like references to check, references on the founder and talking to the team a little bit more as well.
Great. There's another question here from Josh. Have you noticed a trend about what sort of products, services are currently being addressed? In other words, are startups tending to lead toward custody solutions, DApps, or something else? I don't know, DAPS.
Yeah, DApps. So just to make sure I understand the question, just in terms of what people are building right now and what are some of the trends? So in the blockchain space, I think there has been a big boom in what's called the DeFi world, so decentralized finance. There are a lot of projects that are being talked about right now, whether that's Compound or Curve protocol or Uniswap. There's a lot of activity there. So that's probably one of the biggest areas that I would say we're seeing a lot of traction and just a lot of founders who are looking to build in that sector of DeFi. And then, custody and financial infrastructure, I think, continues to be a trend. It's something that has been around for a little bit longer, so the market is a little more saturated. But we continue to also see projects that are going after, whether it's custody or lending is really big right now. So, projects like BlockFi, et cetera, that continues to be a trend as well. Less on the dApps, I would say. Although, it's potentially up for debate if you consider things like Compound and MakerDAO, et cetera. Those could be considered dApps as well.
Great. We have another one. What are organizations that might assist first-time women founders in becoming familiar with prospective investors for their products?
Yeah, that's a great question. So there are a few different groups that I think could be helpful. Off the top of my head, there's a community online called Alpha. They're kind of like a women's networking group online that you can kind of join in. I know there's a lot of venture capitalists, founders who are active on that platform, and I think would be open to folks reaching out. I think Twitter is a great tool. I know it's tough, but if you have a list of venture capitalists that you want to chat with, I think engaging with them on Twitter is a great way to start a conversation with them. All Raise, which is an organization that's focused on women in venture, also does female hours. What are they called? I'm blanking on the name right now. Office hours. There we go. So they do like female founder office hours. So I think there's an opportunity to sign up for that. There's a few other organizations that are a little bit more geared towards like female founder mentorship. I'm blanking on one of the names right now, but I think if you kind of do a little bit of a search around, you should be able to find a few of those organizations. And if anyone wants more specifics, feel free to reach out to me, and I'll try to find some of those names, and I can help you out there.
Do we have more questions, or I can ask one?
Go ahead.
Yeah, so Kinjal, what are you seeing in terms of the current economic cycle with COVID and a lot of things basically shaking up the way we work in terms of investments into new companies or even into companies that existed pre-COVID? What are some trends from a VC perspective, specific to blockchain capital, just generally, that you're seeing? Are VCs slowing down in investments? Are they focusing on certain sectors now that, you've seen how it works in a pandemic situation? Curious to hear your thoughts.
Yeah, it's a great question. So I think there's there's two sort of buckets that I would put folks in. So first is the VCs that I think were a little bit disrupted or sort of slowed down in their capital allocation. I think a big part of it was a little bit of a shift of work, their workflow. So I think some investors, when we started moving to remote and there were a lot of challenges for some of their portfolio companies, a lot of VCs shifted to, helping out their portfolio as much as possible. And kind of helping them in a way that they might not have had to all at once previously. I think you're always working with your portfolio companies, but it's rare when you're in a situation where you kind of might need to work with a majority of them to help them figure out, making sure they have enough runway for the next 12 to 18 months, or making sure that they can kind of weather the storm per se. So I think a lot of venture capitalists ended up allocating disproportionately more time to their existing portfolio, and that resulted in a slowdown in capital allocation simply from a time perspective. So I think that's one bucket. And then the second is, and even in that bucket, I think folks were also trying to kind of figure out how to do remote pitches. I think a lot of venture capitalists love meeting their founders in person before committing to an investment. So I think, everyone's getting over that now, of course, but I think there were some folks who needed to take a little bit of time to figure that out. And that might've been why it slowed things down. So I think that's broader VC. And then I think it still stands that a lot of folks who are allocating capital, they also need to manage the capital that they have. And so depending on where they were in a cycle, if they had just newly closed on a fund, then they have a lot of dry powder per se. And dry powder meaning they just have a lot of cash to invest, which is great, versus someone who might have been a little bit later in their cycle, and has to manage a little more in terms of their allocation to different companies. So I think that's just broader some of the dynamics that were happening in VC. In blockchain, things have been raging. Honestly, it's been great for, and I don't mean this in a way of of course, COVID has been challenging for everyone, but I think the industry has seen a lot of momentum over the past couple of months, whether it's through the performance of Bitcoin and the halving, whether it's some of these DeFi projects that are doing some crazy growth, having some crazy growth and traction over the past couple of weeks. And I think just from overall energy in the space, I think the blockchain side of things has actually proven to be quite resilient and continues to kind of push forward in a strong way. Not to say that they're not impacted, of course, but I think it's just a little bit less so than we might have expected originally. Is that helpful?
Yeah.
Hopefully that answers your question.
Thank you. I guess the blockchain companies, a lot of them were already remote, if not, majority. Yep. So it didn't impact companies, generally in tech as well, didn't impact as much as other industries.
Yep, exactly.
Great. Are there any other questions? I think that about does it. So thank you all again so much for being here. Obviously, please feel free to reach out to Kinjal. Kinjal, thank you so much for sharing all your insights with us today. I learned a lot. I'm sure a lot of us did, so thank you again. This recording will be posted on YouTube on the Women Who Code YouTube channel in a couple of weeks, so please keep an eye out for that. And Kinjal, if they want to get a copy of your resources, would we be able to get a link?
Yeah, absolutely. Yeah, I can definitely share that.
Awesome. Well, thank you so much, everyone.
Thank you so much, everyone. Thanks for tuning in. I appreciate it.
Thank you, Kinjal. Bye, guys. See you at the next one.
Bye.